Hi everyone, Mr. H here. This is the first chapter of Finance and Accounts, 3.1 Sources of Finance. Due to the extension of this presentation, it will be divided into two parts, so this is part 1. Finance is a key element for every business. I mean, you need money to start your business and you also need money to keep it running. So deciding where that money comes from and deciding how you're going to spend that money are important concerns. Before we go on to the specific sources, let's talk about expenditure for a while. You are going to use your money, the money you get for your business, in two possible directions or for two possible purposes. They can be either capital expenditure or revenue expenditure. So using your money as capital expenditure means you're going to use your money to acquire long-term items known as fixed assets, and it means you're using your money to buy machinery, land, buildings, vehicles, or equipment. On the other hand, you can also use your money as revenue expenditure, which is using your money to pay for day-to-day operational expenses like the rent, salaries, raw materials, insurance, fuel, energy, water. Okay, so paying for all those day-to-day, month-to-month expenses are considered revenue expenditure. These are the two possible directions your money can take when you use that money in your business. Now, let's go on to the sources. Where do I get this money from? Sources of finance can be divided into two types. One is internal sources, okay, which is all the money you can get from the business itself and from yourself, and the external sources, money you can get from external institutions or people. In this course, we will explore these 3 internal sources and these 10 external sources. Additionally, sources of finance can be classified also by term. So we can talk about short-term finance or short-term expenses, to the ones you usually use for day-to-day activities or month-to-month activities. And if you have to pay back for them, you would pay back in up to 12 months, in no more than a year. Okay, 3 months, 6 months. Another possibility are medium-term expenses or medium-term finance, which is money that you use for specifically vehicles or equipment, like medium-term expenses. And if you have to pay back for them, they are usually paid back in a year, 2, 3, up to 5 years. Finally, we have long-term expenses, long-term finance, and long-term expenses are those that are intended for bigger projects or investments, for acquiring property or more expensive assets or bigger assets. And if you have to pay back for them, for those expenses, these would actually take from 5 up to 30 years. Okay? So this is another way to understand the sources, by the terms. When we analyze or explore each of these 13 sources, the 3 internal and 10 external, these icons are going to appear on top of each, so you can tell exactly if they are short-term expenses, medium-term, or long-term. Okay, so let's go on to the sources, the internal sources of finance. Internal sources of finance are 3: personal funds, retained profit, and sales of assets. Personal funds are your personal savings, the money you got to yourself, even from a bank account or under your mattress. It's your money, the money you've been saving, and you can use your money to start a business or to keep the business running. Two benefits of this is that this money is easily available. It's your money, is there, and obviously because you're not paying it back, it's not money from a loan. There's no interest. The disadvantages is that if you are using up your personal funds, you are putting yourself at a greater risk, because if your business goes wrong, if your business decision goes wrong, then you just lost your money. So you're putting yourself at risk. And sometimes our personal funds are not that big, are not big enough as to pay for bigger investment, or like start a business or pay for something. So in your business. So your personal funds might not be enough, and then risking to use up that money actually might not be a wise decision. Retained profit, on the other hand, is money or the profit you get after taxes and dividends. That is, after a period of sales or after a period of providing a service, all the money you get from that, called revenue. After all that revenue comes in, you have to cut the cost. You have to cut like all costs. You have to cut all taxes that you pay, and then you even have to cut all the dividends that are distributed to all the shareholders or the partners in the business. And then the money that is finally left, that is called the retained profit. And that retained profit can be reinvested into something else. It can be turned back to the business. So if you do that, the benefit is a permanent source of finance. It means that you don't actually have to pay for this, pay it back. Obviously, there's no interest, and since it's your own money, you can actually have flexibility. You can decide where that money goes and how you're going to use it and how much of it you are going to use. The drawbacks are that if you're a startup, obviously you don't have any retained profit because you're just starting and you don't have any retained profit to start. And if you're a small business, your retained profit might be quite small, so it will not be a good idea to just rely on it for a new investment. And actually, something wiser with the retained profit is keeping it or saving it as emergency funds. Overusing it might put you at risk if your business faces like a global pandemic, for example, and then overuse of that retained profit would leave you without any additional funds to cope with an emergency. So you gotta be careful on how you use that retained profit, or careful with overusing it. The last is sales of assets, and is basically selling unwanted or unused assets, which means like you have some machines or tools or equipment or vehicles or land or property or building that you're not using anymore, either because it became obsolete, talking about the equipment, or too old to keep using it, or they just became unnecessary for your business. So a wise way to work with them is getting rid of those unwanted or unused assets by selling them. So you sell them, and obviously that money comes in. You don't have to pay back for that. It's a permanent source. There's no interest, and it's a wise way to free capital that is tied up to one specific asset that you're not using anymore. So it's a wise decision to turn those assets into cash. However, only older businesses can do this. Obviously, if you are a new business or startup or a young business, you might not want to get rid of any of your assets. All of them must be currently in use, so there wouldn't be a reason for you to sell them. You actually would like to keep them instead of selling them. So older businesses are the ones who might have some assets that they would like to sell. And another thing is that if your assets are like obsolete machines, trying to sell them might be a time-consuming activity for your business, finding someone who would actually be willing to buy it. So these are the three internal sources of finance. Now let's go on to the first three. But before that, before I go on, retained profits are usually used for medium expenses, medium term expenses, and as long term expenses. Sales of assets are usually intended for medium term expenses. I didn't set any specific terms on personal funds because usually personal funds are not that big, and the destination of your personal funds will depend mostly on how much you actually get, and if you don't have enough, it would be actually a better idea to just keep it as savings. Let's go to external sources. The first external sources of finance are share capital, loan capital, and overdrafts. Share capital, known as equity capital, is selling your shares. This is common in public limited companies and private limited companies. You decide to sell your shares privately if you are a private one, or in the stock market if you are a public limited company. People would buy your shares at a specific price, and that's how you get extra cash from the sale of your shares. Good thing about this, and this money is permanent. You don't have to pay back for this, and there won't be any interest. However, you have to keep in mind that by selling your shares, you are selling part of your business. So you are sharing your ownership and control to other people, which means they will also receive part of the dividends that in the first place were intended to you and the other partners or shareholders. Uh, then they will be divided into the others who bought the shares. The other situation is that ownership of public limited companies might be diluted among all the new shareholders, or even lost if one of them buys more than buy more shares than the ones you got. So you actually might lose ownership of the business if you are careful. So this is one way, another way to get funds. Loan capital is the second one. Loan capital is basically getting money from bank. Getting a bank loan is also known as debt capital. And the good thing about these is that it is accessible money. Most people can actually get a bank loan, even a sole trader, up to the biggest company you can imagine. All of them can actually access to a bank loan most of the time. Repayments will not be immediate. The repayments are usually spread in a number of months or years, so it is comfortable to pay in small installments or repayments. And if you're a bigger business, you have a benefit. Most banks will actually offer you the loans at lower interest rates. Problem is, obviously, because you're getting money from a bank, they will not just charge the money back, but they will also apply a specific interest to the debt. So you have to pay some extra money. Some interest may be fixed, but others will be variable, and variable interest might change from month to month, from year to year, and sometimes they can become too high for you to handle. The other situation is that when you have a bank loan, when you have a debt capital, you are bound to pay that money. So even if your business goes wrong, you have to pay that debt anyway. Okay? So that's something important to consider. Overdrafts is a specific benefit that some businesses get from banks, is basically withdrawing more money than currently available. Okay, this means that you have this specific amount of money in the bank, but the bank allows you as a business to take a little bit more if an emergency shows up. Okay, benefits are that it allows you to spend more than you get available. So it also adds you some flexibility, knowing that the bank will allow you to spend a little bit more. It gives you some extra flexibility, especially for emergency situations. Problem is, usually these overdrafts will have to be paid with a high interest, and the bank might require you, actually, most of the time, they will require you to pay it back in a short term, 3 months, for example. So you have to pay them very quickly at a high interest. So it is not a good idea to get an overdraft for a long-term investment. It's actually way better to get an overdraft for short-term situations or for specific emergencies. Um, Talking about the terms, share capital is a long-term type of expense. Yes, obviously, the new shareholders will stay long, even forever. Loan capital can be medium term or long term, depending on the number of months you have to dedicate and how much money they are actually giving you. And finally, overdrafts, as I just said, are perfect for short term expenses, and they will be required to be paid back in the short term. So we're going to stop here with these three first external sources. In the following video, we continue with the other 7. Okay, that's it.